Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. A couple of weeks ago, I talked about the health of Australia's banks. The Australian Prudential Regulation Authority, the regulator, did its annual stress test on the banking system, looking at what would happen if unemployment went to 10%, inflation stayed high, and house prices fell by 1/3. The full results aren't out yet, but under those conditions, all banks seem to look like they'll be maintaining sufficient liquidity, or at least the Big Four will. In short, from the regulator's perspective, the Big Four banks are in pretty good shape. But what about for investors? Morningstar has released its Australian Bank Industry Pulse third quarter report, looking at all the big banks and where the risks and opportunities might be. Remember, this is general information only, and you should always speak to a professional advisor before making any investment decisions. Nathan Zaya is Morningstar's bank analyst. Nathan, welcome to Fear and Greed.
Morning, Sean. Thanks for having me on.
Banks are such a big part of the market, and financials, I think, 25% of the ASX. So if you're investing in the ASX, it's something you have to consider. What should you be looking at? What should you be assessing when you're thinking about investing in banks?
I think the first thing, like when you're investing in everything, is the valuation. So what is priced into that business? Yeah, because when we look at banks as a whole and our coverage list, that we see opportunities in some, and there's some that look fairly valued and overvalued. So I think that is definitely one thing. I think the level of profitability, because like you said, we could enter a period where economic conditions deteriorate pretty quickly, and then you have bad debts rising fast. So the more profitable you are, the more of a buffer you have to absorb those losses. The capital position of those banks. So again, how much of a deterioration in credit quality can they absorb without needing to go to shareholders and ask for more money? So those are some of the key things. I think profitability, so the level of return on equity, is very important because it means they're able to generate organic capital that helps continue to fund loan growth and pay dividends at the same time.
I want to get into the specific banks in a moment, but the sector as a whole, it just seems at times, a couple of years ago, ANZ was flavour of the month. Westpac seems to be more the trend now. Over the long term, do specific banks tend to outperform the others, or is it a sector that kind of eventually moves in step with each other?
I guess time will tell. Like historically, there have been, like you said, times where one is doing very well, and then one might have the upper hand, whether it be make a decision around investment in technology, or in Westpac's case, you have a couple of own goals, with the AUSTRAC investigation and even ASIC over responsible lending picked on Westpac. So there can be those specific things that hurt you. But yeah, in general, there's not a material difference in terms of what they're offering. There's differences in terms of where they're at in efficiencies and their own back office, how efficiently they're processing loans and that sort of thing. And what I think integration across systems and brands, where you're at with that, can be playing a role. But yeah, if you look, say 10 years ago, I think, just talking share price here, so not a total return, you have Westpac's down over 30%, ANZ and NAB, call it 15 to 20%, and CBA's up close to 40%, call it 35%. So a very big difference in performance. But yeah, in the next 10 years, will that look exactly the same, or will some of the issues that a couple of those names have had that have let the giant in the room do even better, will those sort of swing back? We think it's probably likely that the next 10 years doesn't look exactly like the last 10 years.
Okay, so maybe let's talk about Westpac then. We'll stick with them before we get to the giant. What's your view on Westpac?
Yes, so I kind of touched on it, but yeah, we think what's happened in the last few years, which has led to it. So the share price underperformance, that's been driven by an earnings underperformance as well. So they've been losing share in home loans, so revenue going backwards, and at the same time, their cost base has been climbing higher than everyone else's. So it's the opposite of what you'd like to see happening. But there was a few things going on behind the scenes. So they were taken to court over responsible lending practices. They had the AUSTRAC issues. So a lot of things that just make the bank harder to do business with. And I think when you have risk and compliance sort of take over, it's not ideal. But yeah, so you've had that impact on the top line, and then obviously a lot of costs going into the business to remediate issues. There could have been some underinvestment in the past as well. So that uplift in risk and compliance spend, and even the spend on technology, it's been quite material. But we think, once you get through that catch up of spend, to fix some of these things, we don't think the cost base should be permanently higher than its peers. So if you look at their cost to income ratio now, it's much higher than their major bank peers. So we think, it can come down a little bit over time. So that's where we think there's opportunity for Westpac's earnings to outperform its peers. I don't think the market is fully on board with that. And the other part of the equation is sort of what sort of multiple people are willing to pay for this business. So at the moment, it's, call it, P of 10, 10 and a half. I think the market's pretty much saying, what happened in the last few years is probably likely to repeat again. We don't believe you will be able to effectively take cost out and grow in line with the market. So I think, if we're right and the earnings do improve, then you get the earnings improvement and you get the market re-rating Westpac higher. So that's why we have a bit of a contrarian view on Westpac at the moment. We're positive on the name.
Stay with me, Nathan. We'll be back in a minute. My guest today is Nathan Zaya, Senior Equity Analyst at Morningstar. Okay, what about Commonwealth Bank? That is the giant in the room, and it has been an incredible force in the last 10 years or so.
Yeah, I mean, there is a lot to like about Commonwealth Bank, and we do like the bank. Its market share, like the dominant position it has, it gives it scale advantages. It has a funding cost advantage, so raises more in transaction account balances than, well, it has and continues to raise more than any of the peers. It gets a lot of flow of lending through its direct channels, so through its branches. So there is a real strong franchise advantage that they have, generating higher ROE. Like, you can go on for a few pages of why Commonwealth Bank's the best, but then it comes down to, again, what is priced in. So even in the last little while, we've seen Commonwealth Banks losing some share because it's not willing to continue down this path of pricing loans at levels where they don't think they're getting an adequate return. So they're not going to have it all their own way indefinitely. So we look at the bank's making it about a 14% ROE now. We think that can grow a little bit higher, but we don't think it gets back to the 18% of the past when CBA used to trade on multiples where it's trading on now. So 10 years ago we would pay 2 times for this bank on an ROE of 18. Now we're paying a higher multiple when its ROE is even lower. So it just it doesn't feel like there's much room, rush move for error. So we do value it at a premium to its peer group, but the question is, how much of a premium should you be willing to pay? And we think it looks a bit overvalued. Even the dividend yield, with a 4 in front of it, you can get a term deposit with a 5 now. So it's we don't think that the equity risks within this business are fully being appreciated at the moment.
Okay, and just quickly, we better go through ANZ and NAB before we get on to the some of the smaller players. What do you think of those two?
Yeah, I think ANZ's similar story to Westpac in terms of it's had its issues, which is why it was losing share, but sort of seems using price mostly, but it's showing that it can handle an increase in volumes without losing share. Its institutional book is doing really well. Yeah, NAB we see fairly valued. I think it's like CBA has executed reasonably well in the last few years, and took the opportunity to grow share while some of those other banks were struggling. So it's kind of, I put the NAB and CBA in one bucket and ANZ and Westpac in one bucket in terms of where they've been in the last few years, and then the outlook. But NAB does have a higher weighting to small medium business, which is something that we're a bit wary of in this current interest rate cycle. There might be more pain there than the others, but still think it'll be manageable.
Okay, so let's get to the non-majors. Bank of Queensland, that's been on quite the ride for the last year or so. Its CEO came and went. Its chair stepped in, and then more recently, its outlook statements haven't been great. What do you think of Bank of Queensland?
Yeah, I mean it's in the weaker position than the major banks that we've been speaking about. It's a higher cost bank, so its funding is more expensive, whether it be in the wholesale market or customer deposits. It's had to rely on term deposits, which are more expensive. So it's getting hit on both sides from the funding costs rising. There's a lot of competition from term deposits at the moment, very competitive in the mortgage market. So its margins are getting squeezed. It's losing share. Its cost base, there's been, I guess, some hope that it'll eventually start to come down as they work on, consolidating and integrating systems, which, that's been a bit of an ongoing saga for a lot of these banks. But the reason we have a positive recommendation on it now really hinges on the industry as a whole repricing more favorably to make a better margin. So we don't think the majors are earning a high enough return at the moment. So following on from that, they'll lift pricing and the regionals will be able to follow. And then over the next few years, it gets that revenue tailwind and some cost out. We're not very bullish on the cost savings, but it's a combination of those that sees an improvement in the bank's position in a couple of years. Still at a material disadvantage to the majors, but yeah, we think it looks cheap at the moment. There is obviously a lot of risk around that execution on costs, and if the industry intensity in terms of pricing on deposits and mortgages does ease, which we expect,
then it could be okay. One final question, because we're totally out of time. In fact, we're about a minute over time because I've been involved in this conversation too much, Nathan. Dividends. Many investors out there love their dividends. Do you think we're going to see dividend growth in coming years?
I think it'll be modest. The earnings outlook in the next little while doesn't look too great. I think we will have some NIM pressure, and then you've got bad debts normalizing from a very low base. But yeah, I think they'll hold or at least grow modestly. But yeah, the one thing where I take some comfort, even if we are wrong on the earnings outlook in the short term, in terms of it being a little bit tougher than we're predicting before a recovery. They are sitting on a lot of surplus capital, so hopefully they'll be able to tap into that to support the dividend if earnings do soften.
Nathan, thank you for talking to Fear and Greed.
No, pleasure. Thank you.
That was Nathan Zaya, Senior Equity Analyst at Morningstar. This is the Fear and Greed Business Interview. Remember, this is general information only, and you should always seek professional advice before making any investment decision. Join us every morning for the full episode of Fear and Greed, Australia's best business podcast. I'm Sean Aylmer. Enjoy your day.